Today's class is going to show you how to use the hourly time frames 20-period moving average to find very high probability trades and to use it as a filter. Most of us trade off of either 5-minute charts or less, or tick charts or range charts. No matter what time frame you use, you can put an hourly chart's 20-period moving average right on your chart by just simply adding the containment bands. The middle gray line is the hourly moving average. Underneath it you want to focus on sells, above it you want to focus on buys, and it also gives you the lower containment bands, which most days tends to contain price, and it makes an excellent profit target in place to look for counter trend trades. I'm going to go through some of the currencies today that found very high probability trades off their hourly. But you can see yesterday the euro was underneath the hourly, came back up, found resistance here, had trouble going down, so you would expect it when it finally does break above the hourly to explode up. That's what typically happens. So the fact that that didn't happen, it had a false breakout from below to above the hourly. When it came back down here 2 hours before midnight, that signifies a very likely trend down. Now, you don't know if it's going to go down over 100 pips like it did, but you do most of the time know it's going to work its way down either to the red 1.5 containment band or the white 2.2, which is a considerable distance away. It's actually 50, 55, 60 pips away. So some of the trades, I'm just going to point them out on the chart. Short there, got out of this. The fact that it wasn't even strong enough to come back and find resistance at the hourly, didn't even make it back up there. When it broke down right here, it's a pretty high probability trade, but just keep in mind that we have a monthly pivot in the previous day's low right here. Very likely not to be that big of a trade, but once it broke through there, it's likely to go down to the lower band, or you could just use the intelligent trailing stop in our software to get yourself out. Nice little pullback trade right here, which didn't lead to much. You would have got out of that trade with a small profit. And then the last trade that you probably would have had was right here. You draw your fibs on that last wave, and most of the time price does not go beyond the 1.618. It's also my second overnight longer term Fibonacci profit target level, so 11 is a great place to get out of that trade. Short at 47, out at 11 for a 36 pip profit. Very nice. Let's look at some of the other ones. Here's the pound dollar. Again, this one was above the hourly, and anytime a currency is above the hourly, it kind of just goes sideways right near it. When it breaks underneath that, it's a pretty high probability trade. You can see it worked its way down to the lower band, like what I told you is likely to happen with the euro dollar. You have this nice little trade right here that doesn't pan out. You're probably going to have a 5 pip loss. Then when it goes sideways right here, you short it again, and notice it went right to my Fibonacci profit target. Anytime a currency goes underneath the lower band, the first sign of it kind of running out of steam, you want to get out of the trade. You don't want to short that far underneath the lower band. It's a very high risk trade. Here's the euro yen. And anytime a currency does not find support at the hourly, and in fact goes underneath it, a lot of times currencies that make a nice little drop like this will come back up and do a retest here. And the fact that it can't get back above the hourly moving average, when it breaks down right here, that's a pretty high probability trade. And again, this one right here. You have your Fibonacci profit target of this wave. Like I told you before, most of the time the 1.618 is the end of the move, and when it happens to be right at and near a couple other major support areas, the previous day's low, the 10-day moving average, our lower containment band, there's not a whole lot of extra pips in that trade. You would have been short here at 97 and out somewhere at 68 for about 28 pip profit. Not too bad. Pound yen. Now you can see when it does hold as support, it's a very high probability place to buy near the hourly. When it breaks from above to below the hourly, you tend to have a lot of stops getting hit and big moves. And anytime you have a big move, the first and usually second time the hourly moving average gets hit, it tends to act as a resistance area and a pretty decent place to go short, maybe somewhere around here at 52. Use your trailing stop if you might have got out with a very small profit or at the lower containment bands. Notice how it went down, up, down, and there's just no more weakness right here. So you could have got out of this very easily somewhere down near 30. You might have been short at 57 on that one. And it went back up to the hourly later today and down as well. This is a good example that when the hourly moving average does act as and holds as support, and again here, tends to lead to some big trends. Anytime you can see on the chart that there's buyers at a place where there normally are buyers, when price goes up, the buyers continue to pay and pay up and pay up and pay up. and you get these nice trends. So it's another use of the hourly moving average. You can see when this one was underneath the hourly and broke out above it, you might have had a small win, small loss. It broke out right here, went up 20 pips, pulled back down to the hourly right here. Notice it had one bar of weakness and then the weakness fell off. Anytime you get a pullback like that, and this might also be an Elliott two-wave pullback as well. Yes, it is. It's one of our Elliott two-wave pullback systems, as well as the hourly moving average. There's not a whole lot of weakness. The only bad part about buying this right here around 65 when it starts going back up is the weekly monthly trends down. But again, yesterday it found support at the previous month's low, which is a very good sign if you're looking to be bottom fishing this. It could not go underneath last month's low. So there were buyers there. So when it started to inch its way up, finally broke out right here, it's likely to continue. And notice how the hourly acted as support twice today in this. And last but not least today, the Australian dollar. Now, the daily, weekly, monthly trends up, it comes down and finds support, the hourly, but is not able to continue back up. It's a very big sign that's likely to reverse. You have a narrow range pattern here and here. When it breaks down underneath there, it's very likely to trend. You always want to draw your fibs on this. Don't get greedy. Get out somewhere. I probably would have exited half here and then half at the second one. So the average exit would have been 70, would have been short somewhere at 83. Not the biggest profit, but upon pullback up to the hourly right here, this is pretty close. Sometimes I go short right here, have tiny losses, and usually if it can't even make the hourly, I will trade a little bit larger on my second trade to get the loss back. Short here, and as you can see, as it starts falling, there's not a whole lot of weakness. I would have probably got out somewhere at 68. So it's 15 pip profit, 7 pip loss. I would have had a bigger position on the short or the second trade versus the first one.